Thanks for taking your time out from your busy schedule. At AIF PMS Experts India, we are thrilled to introduce our brand new show, which is Ask the Expert Show. Through webinars, we aim to share insights into diverse asset classes, forecasting knowledge exchange amongst our investor community. So my name is Devanshu Bindlish, and I am the Vice President of AIF PMS Experts India. With me, I have a speaker, Mr. Keyur Majmudar, who is Principal Officer and CIO from Bay Capital. And the topic of webinar is long-term investment opportunity with Bay Capital products. Let me take a moment to introduce Mr. Keyur Majmudar. So Keyur Majmudar is a managing partner at Bay Capital. He has 30 years of experience covering investment banking, equity advisory, and fund management. Prior to Bay Capital, he was EVP at Kotak Securities, where he conceptualized and built out the non-discretionary portfolio management business. He was an SVP at Kotak Mahindra UK in London. He was involved into building out the offshore asset management business of Kotak UK. Previously, Keyur was with Equity Capital Market Group at Credit Capital in Mumbai. Keyur holds a bachelor degree from Mumbai University and master's in management from Boston University. Keyur is based in Mumbai, India. So welcome, Keyur ji. How are you?
Yes, thank you, Devanshu. Thank you. Good to be here, and thank you to all participants for taking the time to be with us. Thank you so much.
So the format of the show, Keyur ji, is very simple, where we can go ahead and introduce about Bay Capital and talk about on today's topic.
Okay, great. So Devanshu, once again, thank you for those kind words of introduction, and thank you for giving us this opportunity to speak with the larger audience. So very quickly, I do have a presentation, but I'll be a little bit selective and mindful in ensuring that I don't sort of bore everyone with too many
My
slides
pleasure.
and too much of preamble, right? So, so what I thought was I'll just spend maybe a quick 10 or 15 minutes, if possible, on just speaking about who we are and what we do and how we think about investing. And then we can get down to a more interactive sort of question and answer. I'm sure there's lots to talk about given what's happening in the marketplace. And then, of course, we'll leave the floor for questions. So hopefully that's okay.
Sure.
So once again, thank you, Devanshu, and thank you everyone for making the time to be with us. So essentially, Bay Capital is an independent investment firm. We have been around for the last 16 years. And we are very, very unique in many ways. Until about 2 years ago, almost all of our investing was happening in India, but happening on behalf of overseas institutional investors, which means that we were really advising large allocators out of Europe and North America investing into India. And that's what we've been sort of doing. It's only in the last 2 years that we have started to build out the domestic practice, and then the AIF and the PMS, which we are now talking about, is part of that effort. So we are fairly unique in that we've always been outside investing into India, unlike many others who first sort of manage domestic pools of capital and then go out. I think that's sort of one aspect to keep in mind. Through our 16-year journey, we've gone through 2 or 3 rounds of evolution. And again, that evolution has helped us, in creating an identity of our own, because, we are, again, one of the few managers who've had a vast track record and experience in managing both public market investing as well as investing in the private markets. And hopefully over the conversation, we'll sort of get to speak around that. So, that's who we are as a firm. Collectively, as we stand here today as a firm, we sort of manage stroke advice on assets of close to $750 million. The primary pool of capital still is our offshore vehicles. And this consists of our main, flagship fund, which has institutional investors out of the US, and then a small but rapidly growing India-centric business as well. So, that's who we are as a firm. We'll obviously get to some questions around that as part of the conversation. Let me just jump straight in, Devanshu, if you can sort of just allow a screen share. I'll just try and take you
Yeah,
through
it's
a few slides, yeah?
yeah, yeah.
So just
So
bear with
permission is
me.
granted to you.
Oh, okay, great.
Okay,
So
Vijay.
just bear with me as I try and do this, sorry. Is this visible?
Yeah, perfectly fine. If you can make it
Visible,
to,
okay.
yeah, you can make it to presentation mode. It will be great.
Okay, let me just try and do that. Okay.
Yeah,
Hopefully this
perfect.
is clear. Yeah.
Yeah,
So, in many ways, our framework in thinking about investing is, a collection of having invested in India through multiple decades, right? And in that sense, it's helpful because, as you can imagine, over the last, 2.5 decades, over 25 years, not only have we seen good times, because good times are great, everyone enjoys them, but more importantly, we've seen more than our fair share of bad times, right? And it's only in the bad times that we make our mistakes, we learn from those mistakes and keep honing and perfecting the art of investing, right? So it's a continuous learning process. I think in the world of investing, if anybody says we know all that is to be known, then I think that would be a very wrong thing. So we are continuously learning and evolving. And so as a sort of culmination of having invested in India over so many years, right? Our approach is along 3 or 4 broad verticals, right? So in terms of our strategy and how we construct the portfolios, we're always thinking about scenarios, right? And that scenario thinking helps in times like this, right? Because when the going is good, last 3-4 years going has been great. Everybody talks only about returns. Very few people have an eye on risk. And then, many times we're always asking ourselves at different points of time, what if things don't go according to plan? So, there are multiple scenarios that we always try and plan for. And that has some element of, risk management, if you will, as well, that gets built in. The second broad vertical is around portfolio management, right? And portfolio management does not necessarily mean very active chopping and churning and trading and buying and selling and so on and so forth. It just means that you are aware of what you are buying, when you are buying it, for what reason you're buying it, and then at any point of time, particularly if valuations go out of whack with the fundamentals, then we are very open to sort of trimming weights and rebalancing the portfolio, right? So I think that's what we infer when we say some kind of agility in how we manage our portfolios, right? And I think the final thing is just investing in businesses, right? And I think this is an important distinction to make. We always think about markets in terms of stock prices, but I think it's better to frame the conversation around saying businesses, right? So we just buy businesses. These are typically bought from a 3 to 5 year perspective. Very often the time period is even longer. There are many businesses that we own in our offshore vehicle, which we've held for 7 or 8 or 9 years, right? There's 1 or 2 which we've held for 10 years now. Of course, we've managed weights, but these would be businesses that we bought in 2014, continue to hold them now. They're businesses which we bought in 15 and 16, which we continue to hold now. So these are very long sort of duration holdings, and this allows for compounding to happen irrespective of what happens, right? So we look for those quality aspects. Now, quality can mean different things for different people. We'll get to talk about that as we go along, right? And so all of that finally just gets distilled into some of what I've said, right? Which is just we're looking to deliver consistent returns over a longer time period, right? What we're not trying to do is be in the top quartile of any comparable peer group, or we are not trying to be in the top quartile of any high performing mutual fund or what have you, right? We're saying over a 3 or 5 year period, on a risk adjusted basis, can we sort of compound shareholder returns in a fairly consistent kind of fashion? That's what the portfolio is positioned
right.
for. And I think the long term advantage is fairly significant, right? The fact that we
Mm-hmm.
are able to take a 3 or 5 year view, and this is
Mm-hmm.
because we have our end capital that allows us to take that kind of view, right? And therefore
Mm-hmm.
that means that the portfolio is resilient. So, Devanshu, if you permit me, just a very quick thing. So all of that then is distilled into, sort of what we do, which is, really our AIF and PMS strategies. The way we think about it is AIF or PMS are simply delivery vehicles. They're just two delivery vehicles to deliver a more overarching investment philosophy and investment approach, right? So this is, sort of broadly, the strategy. We are looking at a concentrated portfolio between 25 to 30, up to 30 kind of businesses. We given our background and history, we think from a business owner's mindset, right? Because we hold these businesses for a long term, we're trying to think of ourselves as owners of the business as opposed to just buying stocks, right? And I think that's an important distinction. Our orientation is non-benchmarked. So, so although obviously regulatory and otherwise we need to have a benchmark, orientation wise, if you see our portfolio, we are very far off from any benchmark that you can think of, right? And again, that is a very distinct advantage for us. Portfolio construction is agnostic across market caps. We don't build the portfolio thinking we need to have a certain percentage in large, small, mid. We're just looking to identify good businesses and then build a portfolio organically out of that, right? And then therefore it comes to quality, right? And for us, quality means, essentially 2 or 3 things, right? Just return on capital and the ability for businesses to deliver very high returns on capital over a 7 or 10-year frame. And then obviously a very, very high bar on governance and transparency and disclosures. There's a whole list of things that we don't buy, right? And again, we'll hopefully get to talk about that as we go along. And in many ways, that is effectively our starting point, right? There's many segments, many sectors, many pockets of the market which we don't look at, right? And by not looking at that, we think we are shutting out the noise and allowing ourselves to be more focused on, maybe 220 to 250 odd businesses, and then going deeper into those. So, so that's really the investment strategy. Devanshu, I'll pause here. If you have any questions, any observations, anything that you
Not
want to
as
talk
of
about.
now. Not as of now, Keyurji. You can
Okay,
finish this,
sure.
and then if we have
Okay,
a questions,
so
we will go ahead.
correct. So this is broadly the investment strategy. And as I said, I think what we're trying to do is, not work top down on specific themes. We are working bottom up. But as a result of that bottom up process, most businesses land up being captured in these 4 large themes. And we just think that, I mean, the India story, the India opportunity is very well known, well discussed, well understood, right? So I'll not even go into that. But I think these are fundamentally, structurally very solid drivers for India and for Indian businesses over the next 10 or 15 or 20 years, right? So our bottom-up work leads us to, investing in these kinds of pockets, right? So consumption would mean, consumer discretionary names, consumer staples names. Financialization could be banks, non-banks, insurance, many fintechs, for want of a better word, fall into this bucket. Digitization, I think one of the most powerful themes that has sort of been uncovered in India in the last 3-4 years since COVID is many digital stroke consumer internet businesses, right? And many of these have started to get listed. And, we think we have a very unique lens into understanding this whole digitization opportunity. That's the other thing that makes us a little bit unique as far as, investment managers go, right? And then the final thing is again a very sort of niche sort of area, which is I outsourcing, as we call it, right? So when we think about outsourcing, we typically think of TCS or Wipro or Tech Mahindra or what have you, right? A typical outsourcing model, which over a period of time, to our mind, has got increasingly commoditized, right? So when we talk about outsourcing, we're talking about businesses which have a very strong knowledge-based, deep domain science-based businesses, right? So this could be businesses like Syngene, for example, which is India's largest contract research organization, right? So deep domain expertise and working very closely with, the global pharmaceutical majors on some very, very large and important projects which are strategic in nature, right? And what that means is that, the business is not easily replicable by too many people. And number two, obviously, there's better pricing power, and therefore, obviously, the business is not commoditized, right? So there are many other sort of smaller niche verticals on the technology side, engineering, R&D capabilities, for example, right? And L&T technology services might fall into that bucket where, these companies work with the global majors on very deep strategic, projects, not just, digital transformation like Infosys or TCS or Wipro, what have you, right? So the bottom-up work leads to investing in these four compartments, right? Um, uh, and then if you further sort of drill down, there are 4 or 5 sort of things that we are trying to, the tailwinds that we're trying to catch, right? And again, these are well known, so I'll just quickly skip through that. One is, of course, this large shift from unorganized to organized, right? Which is playing out much more accelerated through the COVID period, and before that because of GST, right? So more formalization of the economy. And this is again straddling sectors, right? So you have this great shift from unorganized to organized. The second thing is really premiumization, right? And again, this is a theme, particularly in the last 2 or 3 years. You've seen this K-shaped recovery, as it's called, right? Where many businesses which were at the catering to the top end of the consumer segment have ended up doing phenomenally well, right? And so across businesses, you see this great drive to premiumize, right? Premiumize products, premiumize services, premiumize offerings, right? And I think that's a structural tailwind as India's per capita grows. You will see this premiumization sort of opportunity playing out, right? The third thing is really consolidation in manufacturing and logistics, right? And logistics, you're seeing that play out, better road, rail connectivity, better logistics players who are more sort of integrated and best in class, right? And then, of course, digitization and financialization, we've sort of spoken about. I think digitization is something that hopefully I'll get to talk about, in greater detail when we come to the Q&A. And so I think finally, in all of this, the one question which I'll sort of preempt is, what makes us different, right? Or, what is it that we think we do a little bit differently? And I would sort of just break that down into, sort of 3 broad buckets: people, process, and, experience or temperament, right? And so, we have a very deep pool of talent. I think, this is a people business. This is a knowledge business. And we very carefully constructed the team which sits in Bombay, which comes from very different, diverse, academic backgrounds, different cultural backgrounds, different professional backgrounds, right? And what that does is, it makes the entire investment process that much more robust, right? So we have chartered accountants, we
Right.
have management graduates, we have, all kinds of people from different, ethnic backgrounds. And then this helps particularly in one part of our process, which is the devil's advocate, right? And I'll get to obviously talk about that as well. On the people side, we are also sort of assisted by a team of very stalwart marquee board of advisors. These are, global professionals who've been in the larger investing business for, 30 and 40 and 50 years. So we are able to draw on their knowledge and their expertise and experience as we think about investing in a very rapidly evolving landscape, right? The second broad vertical is really around process, right? And I think the starting point of that is just this filter of knowing what not to do, right? So we will not, or we do not invest in, the commodity kinds of businesses. We don't invest in the PSUs. We don't invest in businesses which are majority owned by the government. We don't invest in very, levered businesses. We don't invest in businesses which are typically cyclical in nature, right? So as you can imagine, that cuts out, more than 50 or 60% of the market, right? Which is simply which we don't look at. And so therefore, what we look at is something that is more focused. And like I said, we are then able to go a little bit deeper on that, right? And I think that just leads us to be more independent thinking, right? And everything that we do is from the research point of view, which is primary research, right? So, we will spend time on the road, we will talk to businesses, we'll talk to competitors, we'll do our channel checks and so on and so forth, right? And then we have this very unique program called the Devil's Advocate, right? So this is very interesting. I think it's something that we do fairly uniquely. Is that if you're evaluating an investment idea, Devanshu, right? One of our colleagues is building the investment thesis, right? Saying why is ABC a good business and why we should own it, and what the thesis is in the 3, 5, 7 year period that we want to hold it. And then what we also have is a contra analyst, right? A contra person. And the idea of this contra person is to sort of just try and highlight red flags that can happen, right? Uh, and the idea is not for the two people to sort of go at each other. The idea of the devil's advocate is to say that yes, this business is very interesting and exciting, but here are 2 or 3 things that we have to keep in mind as possible markers or red flags, right? Just in terms of it could be the business, it could be the environment, it could be regulation, it could be people, it could be a deep bench, or it could be valuation, right? And so that devil's advocate, just continuously is there to ensure that we don't get too carried away, and there is no group think, right? Because if we all agree on everything all the time, then it's not a very robust process, right? So this is something that we built into our process, and very often it leads to very, very good outcomes for us over a period of time, right? Um, and then I think just the final thing is just our orientation, experience, and temperament, right? And because we've invested for so long, we've been through multiple cycles. The long-term orientation is something that definitely benefits. And enough data points to suggest that the longer your time horizon to invest, the lower is the probability of any kind of losses, higher is the probability of making compounding returns, right? So this is the reason why everyone says invest from a 5 or 7 year period, right? Because the moment you have a 5 or 7 year period, times like now, then become opportunities to buy into good businesses and then, buy and hold, right? Uh, and I think finally, just that, we are non-benchmarked. We are not shackled by investing only in, comparison to what a benchmark might look like. We could have a business which is 2.5 lakh crores of market cap. We could also own a business which is 4,000 crores of market cap, right? So we're not constrained in some way by saying we'll only invest in a particular fashion, right? And then I think the final thing is really a firm belief, and I would like to think this, Devanshu, if you'll permit me, right? The Bhagavad Gita is, of course, a very, holy text, right? And I think
Right,
one of the central messages of that is, sukhe dukhe samakritva, right? So,
right.
for anyone who's read it. So, sukhe dukhe samakritva meaning that in good times, bad times will come. In good
Yeah,
times and in bad times, you have to have equanimity. Uh, and nothing is ever as great as it seems. And at the other
right,
extreme, nothing is as bad as we all, always think it to be, right? So, markets
right,
typically move in these 2 extremes. It's important to know that the answer is always somewhere in the middle, and then think accordingly and think rationally, right?
right.
So that's who we are. This is sort of what we do. I just tried to give you a broad brush highlight of things. Happy to just get into a conversation. Let me stop the screen share now. I'll pull up the screen, if there's anything additional to share,
Yeah.
Devanshu.
Thanks for giving insights about the fund. It's a very, very flexible fund where what I have understood, where there is no benchmark which is being followed, and more than the benchmark, always it's looked at the where is the opportunity and where a fund manager should invest. So thanks for giving this insights about your fund. So what do you think? What would be the ideal long-term time horizon an investor should have? And what do you basically mean by the long term when you say long term?
So I would say at least 3 to 5 years. In an ideal situation, most of our investors typically look at a 5 year plus, right? So when I say long term, we're looking at 5 years as a typical period. And what that does is, like I said, right, the longer your time horizon, the lower is your probability of any kind of undue risk, right? And it helps
Right,
smoothen through volatile periods like now. So, 5 years I think is a good enough period which we might construe as long term, Devanshu.
Lovely. So, what do you think uh, on the categorization of large cap and mid cap or small cap? How do you like to throw some lights on that about the fund?
Yeah, so it's interesting that you asked that, right? So I think one of the things that we are mindful of is not getting too again, I'm losing the word in a very light fashion, burdened, right?
Yeah,
Because, sometimes that acts as a burden, right? Or you have to have 60% large cap, you have to have only 15% small cap, and then
right,
you have to have 25-30 with a band of something, right? We
right.
are unconstrained, right? We've chosen ourselves to be unconstrained, which means that
Okay,
we are really looking at where is the opportunity at this point of time, um, and where can we find businesses which are enduring and durable and unique and in many ways monopolistic, right? Which can compound earnings at close to 20-25% for the next 5 or 6 or 7 or 8 or 10 years or more, right? Now what happens is very often those businesses are large cap, uh, and very often those businesses can also be mid and small cap, right? And I'll give you just a simple example of what I mean,
sure,
right? So
sure,
so when I say to you large, dominant, monopolistic kind of business, right? The immediate thing is,
right,
oh, it must be a very well-known name, and it must have a large cap kind of market cap.
right,
This will probably be 50,000 crores, 1 lakh crores, or whatever, right? Now, if I said to
right.
you, I'll give you two examples of businesses, right? So first is Car Trade Technologies, and Car Trade, I'm not sure if you sort of know of the business or if you've
Yeah,
heard of it, but this is a
yeah.
business that, as it happens today, is the largest holding in our AIF, right? The
Hmm.
market cap is something like 5,500 crores, so by no means it's a large cap, right? But it's India's largest, most dominant uh, classifieds platform, right? It's a
Okay,
technology business. It's a
okay,
monopolistic business, and
okay,
it's India's largest, right, and most dominant, right? And it happens
okay.
to be what you might construe as a mid cap, right?
Yeah,
The other is a business called Ixigo, right? Ixigo is
yeah,
again India's largest online travel agency platform for
yeah,
bus and rail bookings, right? Again, this is a
yeah,
business which has got listed back in June.
yeah,
Again, large, dominant, pretty much monopolistic for bus and rail bookings,
yeah.
uh, and technology, and very, very unique, right? There's literally no one else who is doing that for buses and trains in India, right? There's many others for airlines, but
Yeah,
virtually no one for that, right? And again, you might think of this as being, because it's large and monopolistic and dominant, being a large cap, but it's really in the zone of what you might call
technology
a sort of
driven
a
platform.
technology driven, basically 5.5-6,000 odd crores of market cap, right?
Right.
So this is the point I'm trying to make. So we are not saying, oh, we are looking at large, dominant, monopolistic category leaders, and therefore we have to
Hmm.
gravitate towards to large caps. We are saying we're looking for very unique businesses which are sort of virtually there are no other businesses like that that exist, right? Which give them a large runway for growth and obviously the ability to compound, right? And if that
Right.
means that they are sort of mid cap, then so be it. If that means that they happen to be large cap, then that's fine as
Okay.
well, right? So we are not
Okay.
constrained in that sense. Um, uh, and then we are sort of flexible, right? So like I said, today in the EIF, we have a mid cap, which is the largest holding, right?
Hmm.
And it's again very interesting, and we are fortunate because while mid caps or small caps in some cases would be down 10, 15, 20, 30%
Right.
from their recent highs, I am personally quite fortunate that quite pleased that today as we speak, Cartrade is at a new 52-week high, right? So again,
Yeah.
just to make the point that, there are these unique businesses which are doing something very different, and that is leading to, outcomes which are very different from what the larger market might be doing, right? So I'm just
Yeah.
making an observation. It is not to say that, Cartrade will do well or not do well or what have you. I'm just
Yeah.
giving that as an example to highlight and hopefully answer the question that you asked
Yeah.
as well.
Yeah. So we are not discussing any stock here.
Yeah.
We are
So
just
I
taking
just
an
gave it as you
example.
an
That is a
illustration. So
disclaimer which
that's
I
a
would like to
disclaimer. Yeah,
highlight to
exactly.
my.
Yeah,
So usually
absolutely. So
people
this is
go
not
and
a,
then yeah.
yeah.
So
So again,
this
I'm
is just a
placing
disclaimer.
it for the
Yeah.
recorder. This
Yeah.
is, please do not construe this as any investment advice.
Right. Right.
Anything that is said from the point of view of making just an
Right.
illustration or an
Right.
example. We are
Right.
not offering investment advice one way or the other.
Right.
Just to
Right.
be very
Right.
clear.
Thanks for highlighting that. So usually, investor community go and then
I
purchases
understand.
that stock, and then
I understand. I
unfortunately we
understand.
don't want people to get into those kind
Absolutely.
of stocks. Yeah.
Absolutely.
Coming back
Absolutely.
to our topic
Absolutely.
again, sorry for the disclaimer in between investors. So, coming back to the topic again, what do you think? How soon portfolio should be churned, and what is your strategy? And at what time period you churn the portfolio, and how do you churn the portfolio basically? What is the strategy behind churning the portfolio?
Correct. So typically, as you might have sort of guessed, right, in the way that we think and the way that we invest, uh, the churn on the portfolio is relatively less, right? So we are not looking to trade, just to be clear, we are not looking, from any near-term horizon. We don't have any kind of stop losses, etc., in place. We are really, buying and effectively holding businesses from a longer term point of view, right? That said, uh, two things can happen, right? One is either we trim and rebalance weights, which means that if you're holding a portfolio and something ends up doing extremely well, and we think that, relative to where valuations are, the stock price is doing something else, we would trim and rebalance weights. That is something that would lead to some kind of portfolio activity. And the other is really selling out of names, right? And it's an interesting point that you brought up as well, Devanshu,
Yeah.
because we all talk about buying and what we like to buy, etc., etc. I think it's very important to have a
Yeah.
sell discipline as well, right?
Yeah. Yeah. Yeah.
When to sell and why to sell, right? And we spent some time thinking about
Yeah.
this, right? And we've sort of crafted a thesis around selling as well, right? And the reasons for selling are in some ways a mirror of the reasons for buying, right? And so typically exiting from positions for us would be on account of three or four factors, right? And I think everything that we do is around these three or four factors, right? So the first factor is, you know, governance. So if there is any kind of, governance related issue, then that becomes a red flag. Fortunately for us, that has never happened because, the hurdle for us to buy into a name is very high. So, we don't get into certain types of businesses or certain types of promoters, etc., right? But that would be an important marker. The second is capital misallocation, right? Now, in many of our portfolio businesses, particularly some of these digital businesses, they're sitting on very large, pools of cash on the balance sheets, right? And what happens is there's always a fear of capital being misallocated, right? They'll end up doing something unrelated. Somebody will go out and make some kind of, exotic acquisition in Australia or Europe or
Right.
someplace else, right? So I think
Right.
capital misallocation is something that is very, very important, right? Because that is what differentiates a good business from a not so good one. So we are always on the alert for that. The third is really change in the thesis, right? Or a thesis not playing out, right? And this is fairly normal. It has happened to us in the past. It will happen in the future, right? Not everything that we buy will play out in the way that we want, right? So we have a certain thesis, and at times what happens is that the thesis either gets damaged or the thesis does not play out in the time frame that we want, right? And we give the business sufficient time, but there could be multiple reasons, right? There could be some change in the environment. There could be some, change in the business model itself. There could be some change in the people, right? There's a huge churn of people, and so therefore the whole thesis gets fundamentally damaged, right? And if that happens, again, we would give the business sufficient time, but that becomes a good point for us to exit, right? And I think the fourth most important thing is overvaluation, right? And again, valuation is a very loosely word term. There is no great science to it. It is not that 35p is good and 80p is bad, right? If it was so easy, then we would all be doing this very happily, right? So it's really a call on judgment, long-term earnings and where valuations are, what the business is building in, and in certainly times like the last 2 or 3 or 4 months, right? What has been helpful is for us to take a step back and say that what is the current stock price building in, right? Um, and that always provides a good perspective, right? Because hopefully again we'll get to talk about this. I think there are so many problems in the world, but one of the primary reasons why the market has fallen and is in the shape it is in is that earnings growth is simply not there in the way that stock prices were projecting, right? And I think this disconnect was a very big disconnect. It has only got more extended in the last 6 or 9 months, right? And so there have been pockets of overvaluation. We just have to be mindful of that, right? So if there's massive overvaluation, then we will simply exit and then rotate into a different name with a better risk return kind of profile. So those would be the 3 or 4 broad reasons why we would exit. Otherwise, you could just have portfolio actions around trimming and balancing of weights, Devanshu.
Okay, so let's talk about little bit about markets as well. You are seeing,
Yeah.
markets are falling down continuously. What is your view on that? Because investor community is very, very interested to know
Yeah.
about that views as well, because you as a fund manager should
Yeah.
have a great view about the market. So if you can throw some lights on that, it would be a great help. Uh,
Yeah. Let me put a disclaimer and say that
yeah,
if
that
any
is
fund,
much
no,
required.
yeah, if any fund manager is saying to you, I know exactly what is going to happen and I know where the bottom will be, then that's simply wrong, right? So to believe that I know, where the broader index is going or where the bottom would be, the honest answer is I don't know, right? Uh, that said, I think what is happening is a good thing, because you know there is a natural readjustment of stock prices to what is fair, earnings growth, right? And like I said, I think clearly over the last 3 or 4 or 5 months, right, that disconnect was only getting extended, right? So I think this fall has been good. If you look at the headline index, the index may be down only 7 or 8 or whatever 9% from the recent high, but interestingly enough, and the good thing is that individual stocks, right, are down anywhere between 20 and 50%, right, from their recent highs, right? And that is always a good. I mean, it's sad, unfortunate when investors end up losing money, but what it also does is it helps investors take a longer term view and invest in businesses, right? And it all comes back to that: invest in businesses with a 4 to 5 year period. Invest in businesses and invest with partners who know what they're doing and why they're buying. So if you ask me why are we buying ABC, there will be a thesis and there will be a reason, right? We're not buying something simply because there is momentum, there's a whole lot of excitement and things are looking good, right? That's like a terrible reason to sort of buy. So I think what is happening is a natural process of adjustment. I think there's many things that have happened in the world in the last 3 or 4 5 months, but I think fundamentally, right, there is a temporary problem in India, right? And I mean problem in a very wide sort of way, right? And the problem is around demand, right? There is a demand problem in India. I would like to believe that it is temporary. It will probably take maybe 2 or 3 quarters for that to play out. And I think in that 2-quarter period, the markets will adjust. At the risk of trying to sort of give out a view, which I'm a little bit averse. I think we are maybe 5-7% away from markets may fall another 5 or 7%, but I think a portfolio of businesses bought between now and the next 2 or 3 months, bought from a 3 to 5 year horizon, can end up doing pretty well, right? Because valuations have corrected, earnings will start to sort of come through, and it's important to sort of be very mindful of the types of businesses that you're buying, right? So I think that's really what it is. So the honest answer is, where's the bottom in the market? I really don't know. Can the markets fall further from here? Answer is yes. Have some businesses become much more attractive today compared to, say, last 3 months? Answer is decisively yes, right? And so therefore, I would say to investors that, if you're looking to invest, come in with, 30% of what you're looking to do in the next, few days or few weeks. And then over the next 2 or 3 months, if you are able to sort of use, dips in the market to come in and have a 3 to 5 year perspective, then I think, returns are there to be made for sure. And I think it's really bad times which provide the best opportunities, right? We all know this, but obviously when things fall, there's always bad news, right? So we always want to buy when things are good and looking rosy. The real trick, and this is where the temperament comes in, is to try and really be a little bit courageous and buy when the news flow is the worst, right? And I think we are in that zone now. So I think it's also about tempering of expectations. I think frankly, all of us as investors, we've got spoiled, Devanshu, in the last 2 or 3 years where we are seeing these 20 and 30% kind of returns. I think if a portfolio is able to compound at 17, 18, 19% annualized over a longer term period, then I think that is a good enough sort of mark to have. So that's how we're thinking about things. Like I said, I really don't know where the bottom of the market is. And I would ask you to be very careful if someone says to you, I know exactly when, market's bottom will happen, right? But can things correct from here? I think answer is yes. But is this a good time to come in individual businesses and individual name? I think the answer is decisively yes.
So with that, we will conclude this session, and thanks Keyur ji for coming on this webinar and giving your time out. Thanks our investor community for joining the call. For more inquiries, you can reach out to www.aifpms.com or you can call us at 8368586435. Thank you.
Great. Devanshu, thank you so much for your time. And thanks for this
My pleasure.
opportunity.
Have a lovely day. Bye.
You too. Bye-bye. Bye.